Welcome back to our recording for September SBR mock. We continue with requirement B using exhibit 2. B1 says discuss whether men with core is correct to apply hedge accounting. As we saw, this paper has got different exhibits for the different requirements. So we go and look at exhibit 2. Exhibit 2 goes as follows. On 12th May 20X1, MCOR, which has been a 75% owned domestic subsidiary, it says has been, so it was not just acquired, it was acquired some time back. Subsidiary of FCOR for over 10 years, signed a contract to purchase a major new item of processing plant. The plant will be purchased from a supplier based in Wheatland, where the local currency is the Wheatmark, abbreviated WM. The plant is priced at 5.4 WM million, and this amount is payable when the plant is delivered to MCOR. Delivery has been fixed for August 1st, 20X1, which is like what, May, June, July, August, 3 months. So the plant will be delivered in 3 months' time. In accordance with group risk management policy, MCOR has hedged the purchase by entering into a new costs forward contract on 12th May 20X1 to buy 5.4 million at a fixed rate of $1 to 3.25 WM. It prepared documentation to support fair value hedge accounting prior to 12th May 20X1. Then you are given the exchange rates at the various dates. You are given the spot rates and the forward rates. No accounting entries have been made by MCOR in respect of the hedging arrangement. So you always need to understand what's happening in the question. Failure to understand what's happening in the scenario will make you produce a poor answer. Okay, so take a step back and understand what is happening in the scenario. So in this scenario, MCOR has purchased a plant outside the country. Since they are purchasing from outside the country, it means the currencies between the two will be different. So if you are going to purchase something outside the country, if you want to buy something from South Africa, you are in Zambia, you have to translate, change the kwachas into rands. So equally here, MCOR has to change the dollars into the Wheatmark currency. But since the plant will be delivered 3 months from now. What it means that even though we have agreed the purchase price, the actual dollars to be paid 3 months from now could be different than if we paid now because of movements in exchange rates. Hence, MCO has decided to hedge a forward agreement. Forward agreement is where you go and agree with the bank to quote you a rate which could be used for you at a future date. So you agree on that date, you sign some documentation, and you lock that rate. So on that particular date, in this case 12th May, whatever rate will be applicable on that date, MCO knows that it will buy the dollars at 3.25. So that is a scenario which you have to understand. Then you now need to understand what does the standard say when it comes to hedging. There are two types of hedge instruments. There's fair value hedge and cash flow hedge. They've specified fair value hedge. So if we go to the knowledge, let's quickly review what the standard covers under hedging. So companies enter into hedge transactions in order to reduce business risk, in this case transaction risk, where an item in the statement of financial position or future cash flows is subject to potential fluctuations in value that could be detrimental to the business. A hedging transaction may be entered into. So the aim is that where the item hedged makes a financial loss, the hedging instrument would make a gain and vice versa, thereby reducing the overall risk. So to adopt the hedge accounting provisions of IFRS 9 is mandatory where the hedging relationship meets all of the following criteria. So you need to know these criteria. So the first one is that the hedging relationship consists only of eligible hedging instruments and eligible hedged item. Secondly, it was designated at its inception as a hedge with full documentation of how this hedge fits into the company's strategy. And thirdly, the hedging relationship meets all of the following hedge effectiveness requirements. The first requirement is that there is an economic relationship between the hedged item and the hedging instrument, i.e., the hedging instrument and the hedged item have values that generally move in the opposite direction because of the same risk, which is the hedged risk. The second relationship is that the effect of credit risk does not dominate the value changes that result from that economic relationship, i.e., the gain or loss from credit risk does not frustrate the effects of changes in the underlying on the value of the hedging instrument or the hedged item, even if those changes were significant. And lastly, the hedge ratio of the hedging relationship, quantity of hedging instrument versus quantity of hedged item, is the same as that resulting from the quantity of the hedged item that the entity actually hedges and the quantity of the hedging instrument that the entity actually hedges uses to hedge that quantity of hedged item. So how do we account for a fair value hedge? Fair value hedges hedge the change in value of a recognized asset or liability or unrecognized firm commitment that could affect profit or loss, e.g., hedging the fair value of fixed rate loan notes due to changes in interest rates. Since we are talking about fair values, as you know, are market prices. And market prices will change over time. So there will either be gains or losses as the fair value changes over time. So all gains and losses on both the hedged item and hedging instrument are recognized immediately in profit and loss. The gain or loss on the hedged item adjusts the carrying amount of hedged item. However, if the hedged item is an investment in an equity instrument held at fair value through other comprehensive income, the gains and losses on both the hedged investment and the hedging item will be recognized in other comprehensive income. You remember we covered this where an election has been made to take fair value changes in equity instrument through other comprehensive income. We said that gains in this case will go to OCI, and since these are a result of an election, they cannot be recycled to profit and loss. So take that, remember that. So this ensures that hedges and investment of equity instrument held at fair value through OCI can be accounted for as hedges. So we get back to our question. So the requirement again says discuss whether MCO is correct to apply hedge accounting. So we look at the application, hedge accounting. Men with firm commitment to purchase an item of plant at a future date is an eligible hedged item in a fair value hedge. They gave us that from the requirement in the story that this is a fair. They accounted for it as a fair value hedge. Again, is it correct? We've noted that we use fair value hedges for assets and liabilities. We are talking about an item of plant. An item of plant is an asset. Okay. And the forward contract is an eligible hedging instrument. Menwith can therefore choose to apply hedge accounting in accordance with IFRS 9 financial instrument if it meets all other hedge accounting conditions. We've looked at the accounting condition, the documentation, which we are told in the question that Menwith Cole did prepare the documentation to support the fair value hedge accounting. So the first condition, the hedge should be designated and documented at its inception. This condition is met since Menwith have prepared documentation prior to 12th May 20x1. And secondly, the hedge relationship should be effective. That is, there should be an economic relationship between the hedging instrument and hedged item. This condition also appears to be met since any increase in the dollar amount payable will be offset by a loss on the forward contract for the same amount and vice versa, although there is some ineffectiveness as a result of the forward rate premiums, which means that the forward rate differs from the spot rate on a given date. Hedge accounting is a choice which Menwith has applied to reflect its risk management practice to reduce its exposure to exchange rate movements and manage its currency risk. This provides more useful information to users of the accounts and allows them to understand how the company manages currency exposure. The application of hedge accounting ensures that on initial recognition on 1st August, the price of the PPE is fixed at $1.64 million US, translated WM 5.4 divided by 3.50 spot rate on contract date, and the cash payment is fixed at $1.66 million US, translated from 5.4 WM at the agreed rate of 3.25. If Menwith chose not to hedge accounting to the transaction and the exchange rate continues to weaken, the initial amounts recognized as PPE would be greater, resulting in a higher future depreciation expense, and the cash outflow reported in the statement of cash flow would be higher and may cause users to reach alternative conclusions when considering the management stewardship of Menwith. So in a nutshell, hedge accounting is a choice. You can choose to hedge, or you can choose to ignore the risk and keep your fingers crossed, hoping that the exchange rate will move in your favor, in which case you pay less of your currency at the time when this plant is delivered. We can now move to requirement B. B2, explain how Menwith Co. should account for the hedging arrangement in the year ended 30 June 2021, calculating amounts to be recognized in the statements. To accounting in year ended 30 June 20x1. We already noted in the exhibit that at inception there is no cost. Okay, MCO has hedged the purchase by entering into a new cost forward contract. So at inception there is no cost recognized, but as changes in fair value happen, then we need to recognize the changes in fair value. So the forward contract is a derivative financial instrument. A financial instrument is initially recognized when an entity becomes part to the contractual provisions of that instrument and is initially recognized at fair value, usually the transaction price. Take note that the recognition criteria for financial instruments differs from that of other assets. For financial instruments, we recognize the financial instrument when an entity becomes a part to the contractual provisions. So MCO entered into this forward contract on 12th May 2021, but there are no entries as the derivative has no costs. So at this date, no accounting entries are made in respect of the future purchase. The derivative hedging instrument is subsequently remeasured to fair value at a reporting date, and any gain or losses is recognized in profit and loss, as we saw from the knowledge side. This treatment applies regardless of whether hedge accounting is applied. The fair value of the forward contract is calculated as a difference between the outcome. Okay, there are some issues missing there. Okay, settlement on the same date. If a forward contract were entered into at the measurement date, let's look at the dates. What dates do we have? We've got 12th May, which is the date that we enter into the contract. Our year end is reporting. Our year end is 30 June 20x1. Okay, it's just a month later. So delivery is after the year end. Our year end is 30th June. Then July, August, 1st August, so another month later, that's when the plant will be delivered. So at the year end, we need to recognize the fair value movements at the year end, and then finally we need to recognize any gains or losses at the date of delivery. So at 30th June, the forward contract is recognized as an asset, which is the year end. June, we've got spot rates there, we've got forward rates. presentation is slightly confusing here because you've got 30 June here, first August forward rates delivery, so 30th June the forward contract is recognized as an asset. So you translate 5.4 at 3.8. Our hedge is at 3.25. So we committed ourselves at a higher rate. If you divide 5.4 divided by 3.25, we pay 1.66 million US dollars. 5.4 divided by 3.1, 1.6, 1.69, 5.4 divided by 3.25, 1.66. So we are benefiting on the hedge by 36,575. So there's a gain. If we had not hedged, we would have paid 1.69 million US dollars, but the hedge is giving us 1.66, so there's a gain of 36,575. And this gain we take it to profit and loss. So in a fair value hedge, the cumulative change in the fair value of the hedged item is recognized as an asset or liability, and the corresponding amount is recognized in profit or loss. The fair value of the foreign currency firm commitment at a given date is calculated as the difference between the future cash flow translated at the spot rate on the measurement date. So the measurement date in this case is our reporting date, 30th June. And at the spot rate, at the date the contract was made, the contract was made in May, and the spot rate is 3.3. So we compute, we translate the 5.4 translated at the spot rate 3.3 gives us 1.64 million US dollars rounded off. At the reporting date gives us 1.71 rounded off. So this results in a fair value loss of $77,922, which is recognized to profit and loss. So that brings us to the end of B2. Still under exhibit. So we're done with the exhibits. Exhibit 2, we are done. The next task is using the pre-populated spreadsheet response. Using the pre-populated spreadsheet response options from exhibit 3 and 4 and your previous answers, that is exhibit 1 and 2, prepare a corrected consolidated statement of profit or loss in other comprehensive income at 30 June 20x1, clearly showing any adjustments. So we are going to continue with the requirement C. After looking, so we'll continue with the third video lecture where we're going to look at the spreadsheets together with exhibit 3 and 4. So see you in the next video.